An index fund is like a basket of investments that automatically tracks a specific market index, such as the S&P 500. Instead of picking individual stocks, you invest in all the companies within that index at once. This means instant diversification, lower risk, and typically lower fees compared to actively managed funds. Over time, index funds have proven to be one of the simplest and most reliable ways for investors to grow their wealth, perfect for beginners and seasoned investors alike. Today we will talk about what is an index fund. So before we start, make sure to hit the like button and subscribe to my channel. 1. Introduction to index funds. An index fund is a type of investment that aims to mirror the performance of a specific financial market index, such as the S&P 500, Dow Jones, or NASDAQ. Instead of trying to beat the market by picking individual stocks, index funds invest in all the securities that make up the chosen index. This buy-the-whole-market approach allows investors to benefit from broad diversification and lower costs. Index funds can be mutual funds or exchange-traded funds, ETFs, and they are managed passively, meaning there's no active manager making frequent trades. This reduces management fees and minimizes the impact of human error or speculation. They have become increasingly popular among both beginner and seasoned investors due to their simplicity, transparency, and long-term growth potential. By holding an index fund, you essentially own a small piece of many different companies, which spreads risk while providing steady market-based returns over time. 2. How index funds work. Index funds operate on a simple principle: track the performance of a market index. If an index has 500 companies, the fund buys all or most of those companies' stocks in the same proportion as the index. For example, if Apple makes up 6% of the S&P 500, the index fund will also allocate about 6% of its portfolio to Apple. This ensures the fund's returns closely match the index's performance. Unlike actively managed funds, index funds don't require constant buying and selling. They only adjust when the index itself changes. This low turnover keeps transaction costs minimal and helps investors retain more profits. Index funds may also include bonds, commodities, or international stocks, depending on the index tracked. The simplicity of the process makes them predictable and stable. They don't promise to outperform the market, but over time, many index funds have outperformed actively managed funds simply by keeping fees low and tracking the market consistently. 3. Types of index funds. There are several types of index funds, each designed to track a different portion of the market. Stock index funds follow major stock market indexes like the S&P 500, NASDAQ 100, or Russell 2000. Bond index funds track fixed income securities such as U.S. Treasuries, corporate bonds, or municipal bonds. International index funds give investors exposure to foreign markets, covering both developed and emerging economies. Sector-specific index funds focus on industries like technology, healthcare, or energy. Total market index funds cover the entire stock market, including small, mid, and large-cap companies. Finally, ESG index funds follow companies that meet environmental, social, and governance criteria. Choosing the right type depends on your investment goals, risk tolerance, and time horizon. Some investors mix multiple types to achieve a diversified portfolio. With so many choices, it's possible to invest in virtually any segment of the global financial market without having to research and buy individual securities yourself. 4. Benefits of index funds. Index funds offer several powerful advantages. First, they provide broad diversification. Owning hundreds or thousands of companies in one fund reduces the impact of a single company's poor performance. Second, they have low costs, since passive management requires less effort and fewer trades, resulting in lower expense ratios compared to actively managed funds. Third, they are tax efficient because of low turnover, meaning fewer taxable capital gains. Fourth, they offer consistent performance, tracking the market rather than relying on guesswork. Over decades, markets tend to rise, so long-term investors often benefit from steady growth. Fifth, index funds are transparent, as you always know exactly what you're invested in. Finally, they're simple to use. Even beginners can easily start investing without complex strategies. These benefits make index funds a preferred choice for retirement accounts, such as 400 and Onyx and IRAs, where low fees and long-term compounding have a major impact on final returns. 5. Risks of index funds. Although index funds are generally considered safe and reliable, they are not risk-free. The biggest risk is market risk. If the overall market drops, your index fund will also lose value because it mirrors the market's movements. Unlike actively managed funds, index funds don't try to avoid bad-performing sectors or stocks. They hold everything in the index, good or bad. Another risk is lack of flexibility. You can't choose which companies are included. Additionally, certain niche index funds, such as those tracking emerging markets or specific sectors, can be more volatile. There's also the risk of tracking error, where the fund's performance slightly deviates from the index due to management fees, timing, or imperfect replication. Inflation risk is another concern. If the market underperforms inflation, your real returns could be negative. Despite these risks, index funds remain one of the most cost-effective and historically successful investment strategies for long-term wealth building. 6. How to invest in index funds. Investing in index funds is straightforward and beginner-friendly. First, choose the type of index fund you want: stock, bond, sector-specific, or total market, based on your financial goals and risk tolerance. Next, decide whether you want a mutual fund or an ETF. Both work similarly, but ETFs can be bought and sold like stocks during the trading day. You can open an account through a brokerage platform, robo-advisor, or directly from the fund provider, such as Vanguard, Fidelity, or Schwab. Look for funds with low expense ratios, ideally under 0.20%, no or low minimum investment requirements, and a strong history of tracking their index. Set up automatic contributions to take advantage of dollar cost averaging, which smooths out market volatility over time. Once invested, the key is to stay disciplined, avoid panic selling during downturns, and let compounding work its magic over years or decades. 7. Index funds versus actively managed funds. The key difference between index funds and actively managed funds is strategy. Index funds passively follow a market index, aiming to match its performance. Actively managed funds, on the other hand, hire professional managers who research, select, and trade securities to try to outperform the market. While active managers may beat the index in certain years, data shows that over the long term, most underperform due to higher fees, frequent trading, and the difficulty of consistently predicting market trends. Actively managed funds typically charge expense ratios above 0.5%, while index funds often cost less than 0.1%. That small difference in fees can mean thousands of dollars more in your pocket over decades. 8. Are index funds right for you? Index funds are an excellent choice for many investors, but whether they're right for you depends on your goals. They're ideal for long-term investors who want steady market-matching returns without frequent trading. They work well in retirement accounts, college savings plans, and general wealth-building strategies. If you prefer low fees, transparency, and minimal effort, index funds are a strong fit. However, if you enjoy researching companies, have time to monitor markets, and are willing to take higher risks for potential short-term gains, actively managed funds or individual stock picking might appeal more. It's also possible to combine both approaches, using index funds as your core portfolio for stability and adding active investments for extra growth potential. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.